Aditya Sood of InCred Portfolio Management Services is now joining us on the show. Aditya, hi, good afternoon. Thanks a lot for joining us. How are you reading this current bounce back, Aditya? Because it's got so many people on the wrong side. So many people are waiting to buy on 14,000 or at 14,000 rather, and we have 17,000 rather quickly. In fact, it looks like 17,500 could be here. Your thoughts?
I think so. Sometimes we have experienced in the market that, if you are too cute with timing, it doesn't work. I think so. The correction in a lot of small and mid caps was very, very sharp. In fact, at one point in time, we had close to, 900 stocks which have corrected by more than 50%. Our view is that, it is better to be bottom up in this market because flows can surprise a lot of people very quickly. There has been a lot of selling, $40 billion worth of FI selling has been absorbed by the locals. And our view is that, even if you have a slight bit of buying from the FI side, be it sentiment or be it, a sharp fall of crude, which can happen at any given point in time. This is a very, very good bottom-up market. Plus, what we have seen is that, market was in a phase of earnings readjustment and possibly, earning guidance has surprised in many sectors. Obviously, financials have stood out in terms of performance, in terms of guidance, in terms of low credit cost. So our view is that, it is better to be constructive on a market like India, wherein growth obviously can surprise. India continues to have a slight premium to the emerging market, other emerging markets, and obviously, growth can surprise going forward.
I mean, thanks, Aditya, for joining in. Afternoon, Prashant here. You've got I was looking at some of the top holdings for you, and you've got an interesting mix, really. One name is BBQ Nation. If you can talk us through that name and why that over other QSR chains, which are also listed. What's the rationale behind the decision?
So one is that, we have been positive on, sort of recovery in the consumer sentiment on the discretionary side. We also have, barbecue and United Spirits. We have been holding United Spirits for quite some time now. On the barbecue side, clearly it is one of the better managed, consumer companies on the discretionary side. Obviously, that has got to do with the choice of cuisine, and we see delivery being very, very incremental to their mix. If you look at, their reviews, how they have made a very successful pivot in a down cycle by, taking up a good mix of delivery volumes. Obviously, it is going to be a business which benefits immensely out of incremental capital employed, improving very, very sharply, and same-store growth improving as people return to obviously eating out. So we believe that, it is obviously owned by Jubilant as well. Jubilant is clearly one of the best managed franchises in India, and Jubilant investing into barbecue was clearly a trigger for us to look at this stock.
All right. Hi, Aditya. I'm just reading your note. You have some interesting picks in there. Some of the stocks that have corrected were 30, 40, 50%. Newland Laboratories, case in point. You have Igarashi Motors, the Japanese promoter out there. They're talking about making those DC motors, and there's a huge scope out there. I've done some homework on that. And Aegis Logistics as well. Give us the thesis of this. You believe that some of these stocks are providing good entry opportunities?
So what we have clearly seen is that, a lot of well-managed B2B businesses took a knock. If you look at history of Igarashi Motors, possibly, in last 15 years, they would have never reported a loss, even in 2008, essentially. And what we saw is that, in a lot of B2B businesses, there was a slight bit of, hesitancy in terms of passing on the raw material cost. And now what we are seeing is that, we are seeing sharp recovery in gross margins across these B2B businesses, be it Igarashi Motors or be it Newland Labs. We took this opportunity after a more than 50% correction in many stocks to build up positions. Our view is that, a lot of these companies are structural winners. Some of these companies obviously could be, very, very low in terms of gearing. But going forward, what we believe is that, they have survived an environment which was very, very difficult in terms of, passing on the raw material cost to the B2B suppliers. Now we clearly see that that phase is behind us, and what we see is that, going forward there could be a sharp improvement because a lot of these companies continue to be well managed. So what we are trying to do is that we are trying to position ourselves by focusing on bottom-up stock picking in the market like this.
Okay, fair enough. Couple of other interesting ideas in your PMS. You're betting big on insurance. I see both general insurance like ICICI Lombard and life insurance, HDFC Life in your PMS.
So, these have been recent inclusions. Clearly, what we have seen on ICICI Lombard and Chola being a case in point is that, we were very, very constructive on auto as a segment. Secondly, what we have seen is that, the health insurance bit, which is particularly true of ICICI Lombard, has started to now recover. What we have seen is that, clearly these are very well managed companies. They have gained market share in a down cycle. The way we are positioning ourselves is that, if we see a great company which has gained market, which has the potential of gaining market share in a down cycle, and which is available at a much, much reasonable valuation. Obviously, HDFC Life is a case in point, wherein it is available at 2.5 times price to embedded value. The stock got IPO'd at 4 times price to embedded value. We clearly see downside protection in terms of multiples, and we are benchmarking HDFC Life multiples to one of the best managed insurance companies in the region, which happens to be AI. So our view is that there is a very, very limited scope for multiples to derate in these companies. And there is secular growth which should come through. And this is part of our defensive exposure in the portfolio.
Aditya, Finolex, you own Finolex Cables. I think it was Finolex Industries. I mean, the pipe maker, that's Industries, right? Which in a post-results conference call was talking about how PVC prices have come off quite a bit because of what's happening in China, because demand there has dropped steeply. Could we see that kind of thing spreading across to segments like cables, etc. as well? Any thoughts at all? Because the slump in China is expected to last for a while. I mean, some say it's only just started. Go on.
So if you structurally look at margins of Finolex Cables, they were more like 14% EBITDA margin business. Obviously, copper being a input here, we have seen polycab also being under pressure. But now what we see is that after this destocking of inventory, we believe that the second half is going to be much, much better, and margins will typically mean revert. So essentially, this is also a case in point wherein we are looking at mean reversion of margins, and across the building material space, the demand continues to be very, very strong. Plus, it is a deep value stock for us. They own part of Finolex Industries as well. They own 32% of Finolex Industries. They have got, it is a net cash company. And we expect a growth returning to the sector. Hence, we expect re-rating going forward in this stock.
All right, Aditya, we'll leave it there today. Thanks a lot for joining us. Good talking to you, and we hope to talk to you again in near future.